Good evening, ladies and gentlemen. My name is Pierre-André Chiappori. I'm a professor at the Department of Economics here at Columbia, and it's my privilege to open tonight's session. So for those of you who are not familiar with Columbia, let me remind you that this is the Eugene Sheffer Distinguished Lecture. Eugene Sheffer used to be the director of the Maison Française for 25 years, and the Sheffer family endowed a series of lectures that enables Columbia and the Maison Française to invite public figures, scholars, and people involved in policy. And first of all, I would like to thank the three sponsors for this evening event, namely the Maison Française of Columbia, the Program for Economic Research, which is part of the Econ Department, and also the Jerome H. Chazen Institute for International Business, which is part of the Business School. As you know, our speaker tonight is Jacques de Larosiere, and he will be introduced by my friend and colleague Mike Woodford. I will not introduce Mike, just because I don't think he needs an introduction in this role. Let me just remind you one thing. Mike is considered as one of the leading, if not the leading specialist of central banking in academia those days. And in particular, he wrote a very important book that was published a couple of years ago and which was distinguished by the Deutsche Bank Prize, which is a very prestigious recognition. So I give the floor to Mike Woodford.
Thanks. As you all know, the global financial crisis has presented many important challenges to the institutions that are responsible for making decisions about economic policy. And some of these challenges have to do with the immediate situation and how it's possible to contain or correct the immediate consequences of the crisis itself. But there's another set of important questions which may in fact be with us even longer, which is the question of whether the way in which economic policy decisions are made should be changed in order to reduce the risk of a similar crisis happening again in the future. And one of the important sets of questions in that regard are the one that we're going to hear about tonight, which is the question of the possible role of central banks in reducing the risks of financial crises. To talk to us about this topic, I think we couldn't hope for a more authoritative speaker than Jacques de Larosiere. As many of you already know, Mr. de Larosiere has had a career of the highest distinction as a civil servant in France. He served for many years at the French Treasury, among other capacities as the Undersecretary for Monetary Affairs, and he continues to chair the Strategy Committee of the Treasury. Particularly relevant to the topic of tonight's talk, he's served as the governor of the Banque de France. He's also had many important roles in international institutions, including a term as the president of the European Bank for Reconstruction and Development and a term as the managing director of the International Monetary Fund. Mr. de Larosiere continues to serve on high-level committees, too many of those really for me to list here. I will mention only one of his most recent activities, which was chairing the high-level group on financial supervision in the European Union. This committee presented an important report to the EU last year, recommending reforms of the European financial supervisory architecture. And earlier this fall, the recommendations of the de Larosiere report were adopted by the European Parliament and the Council of Ministers, so they now form the framework that will guide financial regulation at the European level. In particular, it was this report that proposed the creation of the new European Systemic Risk Council that's been established to collect and evaluate information about risks to financial stability at the European level, and also the creation of the new European System of Financial Supervisors, which will oversee and coordinate the work of the various national financial supervisory agencies. So I think it's mostly a tribute to the efforts of Jacques de Larosiere that Europe is now ahead of the United States in developing new regulatory structures to deal with the problem of systemic risk in the world financial system, which have been so glaringly exposed by the recent crisis. But he's not been content to rest on his laurels with this achievement, and he's now turned his attention to the reconsideration of the role of central banks in the light of the crisis. I'm sure we'll all be very interested to hear his reflections, so I'm very pleased to present to you Jacques de Larosiere.
Good evening, ladies and gentlemen. I am delighted and very honored to be in such a wonderful hall with you at Columbia University, which reputation is great, I must say, in my own country. I would like to thank Professor de Menil, who has been the initiator of my coming tonight, and who has devoted a lot of attention and kindness to my visit here, and also Professor Mike Woodford for the very kind words that he has just said. The subject is monetary policy has played a major role in the run-up to the financial crisis. When I arrived in the United States 2 days ago, I passed the immigration procedures, and the immigration officer asked me the ritual question, "Why are you visiting the United States?" And I said, "Because I'm on a business trip." He looked at me, and probably he felt that, it was a bit odd that I was doing business. So he said, "What type of business are you doing?" Well, I said, amongst other things, I'm going to give a lecture at Columbia University. And he said, "May I ask on what subject?" And I said, "On monetary policy." He looked at me, blank. He said, "What, monetary policy?" I said, "Yes, interest rates, credit." "Oh," he said, "well, you can tell them that we made a big mess of it." And I said, "Well, in a nutshell, that's exactly what I'm going to try and demonstrate." Now, the thesis that I will present to you today draws from an article that I published in Central Banking at the beginning of 2010. It was the result of reflections and work that I had embarked upon several years ago. At the time, the article received no reaction. But over the last 10 years or so, a number of economists have been writing on the subject, and central bankers have lately started to pay attention to the linkages between monetary policy and asset bubbles. Furthermore, the recent creation in Europe and in the United States of systemic risks boards or councils entails for central bankers the duty to analyze in an ongoing fashion macroeconomic and financial risks and to make recommendations, including on monetary policy matters, in order to prevent the recurrence of crises like the one we have been living through, and that has had so dramatic negative consequences in terms of growth, employment, and fiscal policies. A number of central bankers and their economic advisors tend to consider that monetary policy played little or no significant role in the run-up to the crisis. On this view, the financial upheaval was mainly the result of an external macroeconomic shock made worse by the imprudent behavior of some financial institutions. Their argument can be summarized and to some extent simplified as follows. Inflation, measured by CPI index, has been low and stable over the years. Therefore, the fundamental objective of monetary policy, which is price stability, has been achieved. Secondly, the financial crisis was basically the result of excess savings and balance of payment surpluses of major emerging economies, who pegged their currencies more or less on the dollar. This caused the surge in housing and other asset prices, and it enabled the US current account deficit to be financed. This excess liquidity created by these imbalances was not caused by monetary policy, they say. And lastly, another factor that explains the crisis is the behavior of a number of financial institutions, in particular non-banks, hedge funds, investment banks, that went too far in leveraging their capital. Now, I believe this argument is seriously misleading, and that the explosion of credit, which is, in essence, a monetary phenomenon, was a major factor, not to say the major factor, behind the crisis. For example, the ratio of US private sector debt to GDP skyrocketed from 112% in 1976 to 295% in 2008. In Britain, the ratio of households' mortgage debt to disposable income has surged from 80% in 91, this is the stock of debt, to 140% in 2008. In the United States, credit expanded by around 10 to 15% per year from 2004 to 2008, when economic growth in nominal terms was around 5%. And in Europe, you had similar things with 8 to 10% annual increase in credit for a nominal GDP growth of less than 4%. This explosion of debt was bound to have monetary consequences. Loans create deposits, as the textbooks used to teach us. The fact that many central banks, and in particular the Federal Reserve, which allowed real interest rates to hover around zero for several years, pushed up credit expansion, which in turn impacted on the monetary aggregates, is not debatable. On the external front, we know from the research done by Jacques Polak in the 60s that it is the evolution of net domestic assets, which is credit to the economy and to the public sector, that is the main determinant of current account imbalances and the variations of those imbalances. So, given the importance of credit for both domestic and external monetary stability, it is something of a mystery, to me at least, that central banks don't seem to have paid much attention to it as an indicator, even though traditionally credit growth has been a major element in the analysis and toolbox of monetary policy makers. At the very least, the magnitude of the credit bubble should have raised questions about the adequacy of monetary policies. Central bankers' response to the view that I have just expressed goes something like this. As inflation, measured by consumer price index, remained subdued, it would have been irresponsible for central bankers to tighten their policies and increase interest rates at the risk of curtailing economic growth and increasing unemployment. Now, that's the way the argument goes. But the implication of that argument would be to limit the operation of monetary policy to the achievement of a strict concept of inflation targeting prices of goods and services, or of a non-inflationary potential growth targeting, as was the case in the United States. Now, after the crisis has struck and left massive casualties in its wake, you just have to remember that in the US, the shift of GDP growth between 2007 and 2009 has been minus 4.5%. and they have reached close to 10% unemployment. Now, even the most convinced defenders of central banks' past policies should, in my view, concede that it would have been appropriate to monitor the credit indicators more closely and act upon them. In any case, they start agreeing on the proposal for a systemic risk council, which is to avoid a repetition of past experience. Some even tend to agree that if regulatory instruments prove insufficient, monetary policy could be used as a supplementary tool in case of excessive credit expansion. At this point of the analysis, I would like to stress 5 of the monetary, quote-unquote, aspects of the credit bubble. Firstly, the expansion of credit, which fueled domestic demand, was a powerful contributor to the increase in asset prices. Furthermore, high asset prices produce wealth effects, which in turn feed into the credit bubble. The richer you believe you are, the more you are tempted to borrow, especially when the banking sector, as it was particularly the case in the US and in Britain, is able to, quote-unquote, extract value from rising housing prices. Strong risk appetite in an environment of low interest rates led to a deterioration of risk quality, to a weakening of due diligence, and to very thin spreads. Further, the adoption of mark-to-market accounting compounded the surge in asset prices and its wealth effects, since, quote-unquote, paper profits and valuations increased in good times and gave the impression that collateral was plentiful and of good quality. Secondly, low US interest rates, which were even negative in real terms from late 2002 to mid-2005, given the inflationary expectations, generated a perverse process. The lower the rates, the more risk was taken. Therefore, the probability of a crisis increased. The crisis, when it broke out, required in turn low interest rates to preserve the financial system. This has been called the low interest rate trap. Thirdly, the systematic pegging to the US dollar of a number of currencies of structural surplus countries like China, but also Middle Eastern countries and others, entailed a significant increase in liquidity and has resulted in lower interest rates. No one could deny that intervention on the foreign exchange markets is a monetary policy decision. The International Monetary Fund and its shareholders have allowed the massive accumulation of excess dollar-denominated reserves by surplus countries, thus condoning, in a way, the consequent surge in international liquidity. Fourthly, deregulation and financial innovation have allowed financial institutions, particularly investment banks, hedge funds, to increase their leverage. The abuse of off-balance sheet operations like special investment vehicles, conduits, etc., and of securitization of complex and often opaque products significantly contributed to the expansion of credit. For a given amount of regulatory capital, these institutions could indeed lend much more by accelerating what I call the rotation of their own funds and getting off their balance sheets the loans they had extended to their clients. The conjunction of an easy monetary policy and weak regulation favored the expansion of financial products like adjusted rate mortgage, which, with rates indexed on short-term low interest rates. This considerably increased the transmission channel of monetary policy and contributed to the crisis. And lastly, credit bubbles, like the housing bubble that the US experienced in the 2000s, can be much more detrimental than the bubbles that are not financed with debt, such as the internet bubble. The banking system had come to rely increasingly on wholesale funding and on the shadow banks which could increase their leverage without regulatory constraints. As a result, a large part of the credit bubble was financed on a very short-term basis, essentially overnight collateralized loans. As long as asset prices were up, firms could easily borrow, given the higher value of their collateral. But this increase of borrowing led to overcapacity in the economy, which eventually resulted later in a sharp downturn. When the cycle reversed, the loss spiral had enormous amplification effects. Indeed, investors, as soon as the value of their assets tumbled, saw their net worth collapse and hence their ability to borrow dwindle. They were left with one alternative, i.e., reduce their positions by selling assets when prices were falling. To make things worse, margin calls and haircuts started hurting investors when asset prices declined and forced them to sell, which in turn depressed assets further and increased margin calls. One can understand, given the high leverage of US investment banks in particular, how much the financial system got into debt. If you look, for instance, at the figures in the United States, from 1978 to 2008, the net debt of financial institutions related to GDP soared from 16% to 121%. You can't understand the crisis if you don't have those types of figures in mind. The financial system relied very heavily on borrowing. Thus, the terrible consequences resulting from the vicious cycle that I have just described. Can one reasonably argue that the 5 monetary issues that I have just analyzed, and I only took 5, have nothing to do with monetary policy and with the responsibility of central banks? I leave that question to you. When liquidity and credit surge in an environment of low interest rates, while the consumer price index remains stable, in large part because of the low wage costs associated with imports from emerging countries, perhaps more than from the wisdom of central banks. And as exchange rate flexibility can no longer play its role as a safety valve, the only outlet is the increase in asset prices. The bubbles were a natural accompaniment of low interest rates and of what I think was an inappropriate and asymmetric monetary stance. Indeed, monetary policy was eased to avoid a downturn with far greater speed and decisiveness than were displayed during periods of gradualist tightening when the economy was overheating. This asymmetry was an invitation to moral hazard, since it created the expectations that central banks would take remedial policy action if asset prices were to fall. One illustration of this asymmetric approach to monetary policy is the liquidity injection by the Fed to prevent a feared but mistaken deflationary trend in 2002. This overreaction produced a massive bubble. Now I come to my second and last section of this little talk. To avoid the repetition of such events, central banks, in my view, will have to start again monitoring the expansion of credit and therefore to get interested in bubbles. The objection is, the objective is certainly not to target asset prices like you can target inflation measured by consumer price indexes. Central banks cannot, of course, determine the right value of assets. This targeting, quote-unquote, objective is often presented by those who defend the central bank's status quo as if it were the alternative solution. This, of course, is in part aimed to discredit the idea that we need central banks to react sufficiently early on to emerging bubbles. The objection is often that central bankers are not in a position, and no one is, to identify a bubble. This seems to me to be a particularly weak argument. You did not need to determine scientifically the right, quote-unquote, value, for example, of houses in the United States in 2005 to know that there was an excessive rise in prices. Actually, everybody knew it. We certainly knew it better than we could forecast inflation or output gaps, which are considered as normal judgments to be made by central bankers. The National Bureau of Economic Research has recently published a paper that shows how, I quote, rising home prices, falling mortgage rates, and more efficient refinancing lured masses of home owners to refinance their homes and extract equity at the same time, increasing systemic risk in the financial system, end of quote. This very illuminating paper shows that home equity extractions alone can account for the dramatic increase in systemic risk posed by the US residential market, which was the epicenter of the financial crisis of 2007-2008. Now, what central banks should do under such ominous circumstances? Should they remain inactive, wait for the burst, and then mop up the mess by reflating? On the contrary, I believe that they should lean against the wind and that they can use different policy options to that effect. They should, in my view, lean against the wing to improve macroeconomic performance by reacting systematically to asset price misalignments over and above their reaction to inflation forecast and output gaps. The reason for this view is that asset price bubbles create distortions in investment, consumption, and inflation, thus leading to excessive, quote-unquote, increases, and then to severe falls in both real output and inflation. Monetary policy can smooth, in my view, and moderate these excesses and fluctuations through interest rate actions. My view is that a central bank would achieve a better performance if it encompassed in its inflation targeting process the evolution of asset prices and not only CPI, inflation, and output gaps. Now, this does not mean that we should put an arithmetic figure to the increase in asset prices that can be concerning. But it means that when you make your judgments in terms of monetary policy, you have to have in mind these trends. One should have in mind that the cost of bubbles can be very high. The IMF, for instance, has estimated, on the basis of past experience, that housing busts take on average 5 years to get normalized and are associated with output losses that can reach over the period something like 8% of GDP. Since asset price variations do impact inflation and in a way are the reflection of inflationary expectations, And given that central banks' objective is to limit inflation, why shouldn't they take into account asset price inflation in their policy tools? They can use, central bankers, different policy options. They can adopt a less accommodative monetary policy. This can provide the market, I think, the right signals, make more credible the anti-inflationary stance in its most comprehensive definition, and thus help to anchor future price expectations. If the market knew ex ante that monetary policy will react to emerging asset price bubbles, that might reduce the possibility of bubbles. They can also adopt regulatory measures to moderate credit expansion, either in general or in specific sectors, like setting dynamic provisioning, increasing reserve obligations, setting more stringent rules regarding loan-to-value ratios, and things of the like. These could be used either as an alternative to tightening monetary policy or a supplement to it. Some might object that increasing interest rates, for instance, is too blunt an instrument to prevent a bubble from bursting, and that regulatory measures are not always within the competence of central banks. These arguments, in my view, are not convincing. Interest rates should be used when needed to lean against the wind, and regulatory measures should be promoted by central banks if they are required to prevent financial instability. This is why the report on the reform of the European supervisory system, which you were kind enough to allude to, has proposed the creation of a systemic risk board grouping the European central bankers and supervisors in order to detect early enough systemic risks and to propose precise measures, including regulatory measures, to deal with them. Lastly, some may argue that if central banks were responsible not only for price stability, but also for financial stability, this could entail conflicts between the two objectives and could weaken their main mission, which is price stability, or even their independence. I believe, in the light of what has happened over the last 2 years, that this is not a convincing argument. Firstly, central banks have traditionally been in charge of both missions, price stability and financial stability. The practice of the last 10 years should not lead us to forget these basic historic facts, and Professor Woodward knows that perfectly. Furthermore, a number of central banks are in charge of micro-supervision of banks. So, and secondly, bestowing on central banks and regulators the responsibility of acting to prevent financial crises, in my view, can only strengthen their authority and independence. And lastly, let us consider the monetary consequences of not acting to prevent bubbles. We have seen the wealth effects of asset prices and the consequences of excessive credit expansion. They have by themselves contributed to overcapacity, to output volatility, and eventually undermined the foundations of a stable financial system. The ongoing deleveraging process will have major negative economic consequences, especially in the most indebted economies, private and public, like in the US and in the UK. Would it not have been wiser to tighten earlier, which no doubt would have entailed some pain, rather than let the enormous credit bubble expand and burst, thus resulting in a deep recession and in a surge in unemployment, which seems incommensurate with what would have happened under the hypothesis of an earlier tightening. Once asset prices started to fall, the whole financial sector almost collapsed. Enormous injections of central bank liquidity, short and medium term, and of public support were needed. We see how difficult it is for central banks to start thinking of an exit strategy? Is that massive intervention and quantitative easing policy consistent in the longer run with monetary stability? Some fear that inflation will come back when the huge liquidity created finds its way into the financing of the real economy. Some others believe that the present degree of slack points more towards the risk of deflation. The fact that these expectations are so different poses a new challenge to central banks and to their credibility in leading to stabilizing expectations. All in all, there seems to me little doubt that monetary policy contributed significantly to the emergence of the crisis. Thus, time has come to question the monetary policy operational model that has prevailed over the last 10 to 15 years. Its basic principles have been tested throughout the crisis and have not, in my view, withstood the test. It is somewhat paradoxical that in a world of increasing financial complexity, central banks have tended to oversimplify their operational policy. One single and narrowly defined objective has prevailed, with some limited variations. CPI, Consumer Price Index, targeting. One single policy tool has dominated the use, asymmetric, of official interest rates. And a blind eye has been turned by most to credit expansion and to the surge in asset prices. Actually, extracting value from high asset prices has become, if you think at it, a main instrument for some important policy makers and politicians to sustain growth. We have seen the dangers, that is, the destruction of value and the generalized assertion of such artificial methods of promoting growth. I would also underline that this so-called consensus on monetary policy is rather recent, as I said, and that the history of central banking, which you know more than anyone, provides a host of more comprehensive objectives and operational tools. In this regard, one can observe that inflation targeting, as it has been practiced, was based on, 2 to 3 year CPI forecasting. This short-term horizon resulted in giving an insufficient weighting to price misalignments, which are at the root of asset bubbles, but which have to be considered on a longer-term horizon. Contrary to the so-called consensus, and trying to avoid any dogmatic approach, I consider that financial stability should be part and parcel of the objective of promoting stable monetary conditions. Asset bubbles can be recognized and eventually acted upon by central banks. Credit expansion should be closely monitored and moderated when needed. When action is to be taken, the earlier the better. Actions and tools should be multifaceted: interest rates, reserves, changes in regulations, etc. In this regard, I repeat that loan-to-value ratios are very powerful tools to prevent excessive credit expansion without hindering the economy with too high interest rates. Anchoring inflationary expectations on a long-term horizon is crucial, and introducing an anti-cyclical dimension in monetary policy, like dynamic provisioning in good days to be run down in bad ones, is also a useful method. Nothing of all this would or should lead to a weakening of central banks' independence. On the contrary, providing central banks with a more comprehensively defined stability mandate could only, in my view, enhance their credibility. I come to the end of my presentation. You have understood that the theme that underlines this analysis is that financial institutions play a fundamental role in the transmission mechanisms of monetary policy. Not a big discovery. However, monetary policy makers were not, I think, well prepared, either analytically or operationally, to prevent or moderate the excesses of credit expansion that eventually brought the system down. A large number of banks with the prevailing Anglo-Saxon originate and distribute model were providing investors with opaque and sometimes very poorly understood financial products whose rating by credit agencies were meaningless. This supply of complex financial products was met by an ever-growing demand of investors whose liquidity was plentiful, in particular because of massive international imbalances and low interest rates. Through the securitization process, banks could, as I say, reuse their capital to originate and distribute again and again. Very low interest rates had therefore a much stronger transmission effect than in the past, when global imbalances, securitization of complex products, financial globalization, and the existence of a vast shadow banking system were non-existent or much lesser. The consequences were, with hindsight, inevitable. The more liquidity was abundant, the easier was the short-term funding through interbank, commercial bank, paper markets, etc. for institutions like banks, mutual funds, pension funds, hedge funds that engaged in investing in these complex financial products. The tide was irresistibly mounting, while central bankers were continuing to focus on CPI inflation, which was okay. It is noteworthy that economists had studied with care and precision the dangers of the credit channel in the Great Depression years. They had rightly pointed out that banks could be major transmitters and shapers, if I could say so, of monetary policies. Banks indeed could tighten their loans because of upcoming defaults, because of high credit risk of borrowers, and therefore because the cost of capital was high. Why then didn't those same economists pay more attention during the boom years to the reverse but symmetrical risks involved in the behavior of financial institutions? Their profits were artificially inflated by accounting standards. Their leverage and risk appetite were high in a context of low interest rates, and concerns on the credit risks of borrowers were reduced as securitization was supposed to spread the risk around. The credit transmission channel was in fact much more powerful than assumed. Indeed, it was paralleled and compounded by the increasing leverage of certain financial institutions, like investment banks in the United States, hedge funds, that behaved as banks, transforming short-term market funding into longer-term assets, but were not subject to as stringent regulation as banks were. The result was an enormous regulatory arbitrage towards hedge funds, off-balance sheet vehicles, SIVs sponsored by banks, but in theory independently managed. That's the parallel shadow banking system. These parallel banks turned out to be accelerators of credit expansion and consequently contributed to loosen monetary conditions. Most of them had little capital and were over-leveraged. The collateral they provided to their lenders was in many cases of dubious quality. CDOs were often accepted. Now, when the markets eventually understood that real estate prices were coming down, the whole structure crumbled. The shameful practice of granting subprime mortgage to borrowers who were known by brokers and banks, as well as by supervisors, as unable to service their loans, became public. The financial products based on subprime mortgages, products that had been granted AAA ratings by inept rating agencies, suddenly were seen as what they were, that is, worthless. Banks and hedge funds suddenly lost their short-term funding, and many did not have either the capital or the liquidity to survive. Those banks, which had been imprudent, had to be rescued at a great cost for taxpayers, and hedge funds were severely hit while they compounded through the sale of their assets the fall in markets. Securitization almost disappeared, far from constituting an institutional buffer against falling markets, as they often had in the past. Financial institutions had become so dependent on financial markets that they were the first to be impacted by the fall in assets and to exacerbate the market downturn. No more buffers. Thus, the old negative channel reappeared as in the 30s, but no one had really struck the alarm bell in the years of overextension. What explains this asymmetry? Is it the great moderation in inflation, which is not well analyzed? Is it the illusion that markets will never fail? Is it the obsession of deflation that appeared in this country a few years ago? Is it because of the implicit belief that cycles had disappeared and that productivity gains would ensure forever high and non-inflationary potential growth? I leave you the answers. The least one can say is that the Great Recession, with its millions of unemployed, its thousands of billions of bailouts, its spectacular rise and deterioration of central banks' balance sheets, cannot be lightly discarded as the result of some external accidents or excessive savings in some parts of the world. Tough questions have to be answered by policymakers, governments, central banks, regulators, supervisors, as well as by financial institutions. It is essential that they address the real causes of the crisis, which I think are major international imbalances, inadequate monetary policy in the context of asset bubbles, insufficient professionalism supervisors, pro-cyclicality of prudential and regulatory rules, accounting, insufficient liquidity during the crisis, excessive leverage of major investment banks and of hedge funds, poor governance, often leading to herd behaviors, short-term biases and incentives. And that central banks get really involved in financial stability so that the huge and, I think, unacceptable moral hazard problem that has plagued the world does not happen again. Are the present efforts to reform the regulatory system adequate? This is another subject which I will not deal with. I think they are certainly, in many respects, a step forward in the right direction, but the emphasis on increasing capital buffers in the banking systems seems to me somewhat misplaced. Insufficient capital was not, by far, the major cause of the crisis. Liquidity was the real problem, and it must be addressed in a coherent way without jeopardizing the vital intermediation and transformation function of the banking system. More attention should be devoted to the quality of supervision and to the likely expansion of the shadow banking system that will, no doubt, take advantage of the increasing capital constraints of the regulated banks. And without a comprehensive international macroeconomic surveillance, imbalances will continue to flourish. In this respect, macroprudential oversight should play its full role in warning governments and markets about nascent deviations or bubbles. Let us hope they will fulfill their mission with independence, competence, and forcefulness. Thank you very much for your attention. Now, if you want to ask questions, I would be delighted to take some.
So we will have some time for some questions, and there's a microphone over there. Is that the only microphone, Pierre-Andre? Is that yes, okay. There's microphones on the two sides. Before anyone who wants to ask a question can go to one of the microphones. Before you do, I would like to comment that Mr. de Larosiere's remarks in response to the questions will be off the record. I don't know if they're members of the press here or not, but if there are, his responses to the questions will be off the record, and if he says something interesting, you should seek him out afterwards to ask if he's willing to say something on the record or not. The other piece of advice I had was that questioners should give your name and your affiliation before you're asking your question. So we have a first question.
I'm an alumnus of Columbia. Has any central banker been fired? Has any central banker been fired?
No, I don't think so.
Why? Not.
Because the policies are what I said. The policies are what I said. I mean, everybody sort of accepted this framework, and you know, that was it. So the analysis that I have presented was not. You didn't find it very easily. There were some economists that were making those points, but you know, there was nothing wrong. Don't hesitate to ask indiscreet questions, because as Churchill said, questions are never indiscreet. It's the answers that can be. So I'll have to moderate.
We have another questioner here.
Yes.
I'm Samina Muhit. I'm an alumni of both the business school and SIPA.
Sure.
And I was wondering if you could make some comments on what's been rumored today about the easing in Europe, possible easing in Europe, quantitative easing that might take place, and being done through the IMF, essentially after we've just had a quantitative easing here. How do you see all this liquidity that's being created? Where will it finally end up?
Yes, thank you very much. This is exactly the type of questions that I would like to avoid, because you are asking me to make a judgment or an assessment of a monetary policy stance which has not yet been defined, if I am well informed, and therefore I will not comment. If you have in mind something else, which is the Sunday arrangement between the Eurozone countries, I am ready to make a few comments on that, but this is perhaps not your question. If your question is strictly quantitative monetary easing, I have to skip that one. But if you're interested in the package, the Euro package of last Sunday, I can say a few words. Are you? Okay. Well, I think the Sunday package is very interesting. I was traveling that day, so I have no particular insights in all that. But what I read made me think that three things had happened which were positive. The first thing is that this European fund or financial mechanism is going to be made permanent and will not lapse in 2013. Now that's very important, because there was an uncertainty in a large segment of the market on what would happen after 2013. The second point, which I think is very interesting, is that if after 2013 a sovereign of the zone is under debt pressure, there will be a systematic intervention by the IMF and the European financial mechanisms in order to determine what has to be done. And the third thing, which I think is very interesting, is that it is understood that if the judgment made collectively is that there is an element of unsustainability of the debt of the sovereign in question, there will then be a mechanism that could lead, at least for the subordinated holders of debt or the holders of subordinated debt, could lead to a restructuring, that is a contribution by those creditors to the financial package. So I think these are three important initiatives that have been taken, and in my mind they should greatly contribute to the stabilization of the Eurozone. That's the way I would put it. But I am ready to take other questions, if you will.
We have a question on the other side of the room here.
Yes.
Yes, I'm going to ask you about a counterfactual.
You should say who you are and your affiliation.
Sorry, Bernadette Kilroy. I'm in the financial industry. You said that because there was not a completely freely floating set of exchange rates in the world, and there was pegging by large emerging economies, including also economies in the Middle East. If that had not been the case, and I realize I'm asking a counterfactual, but if that had not been the case, how severe would the crisis have been?
Yeah, could you synthesize that?
If the countries that you referred to had not been pegging their exchange rates to the dollar, how much would that have affected the severity of the crisis?
Well, it's difficult to answer that question because I have not studied in a quantitative way what would have happened. It's always difficult to evaluate that. But my feeling is that if the exchange rate had shown more flexibility as it ought to, you would have had, by definition, less accumulation of reserves in those countries, less intervention, which are an act of creating liquidity, and therefore that there would have been less liquidity around and perhaps higher ambient, if I could put it that way, interest rates. So I think there is an element here. Now, should monetary policy take as a given that, that's the way it functions, people peg, and personally, I don't think so. I think a proper functioning of an international monetary system is not consistent with very large structural, I would say, countries, either on the creditor side, on the surplus side, or not, to accumulate sort of unlimited reserves or debts. I think the system should be overhauled so that it functions in a more symmetric way. It's easy to say, it is more difficult to do. There are some ideas on how to improve the functioning of the exchange rate system or the balance of payment system. You could imagine recourse to quantitative indicators. American Treasury proposed some caps on surpluses or deficits. They had proposed in the 70s another idea, which was that a country that accumulated systematic increases in reserves or increases in indebtedness would have, after a certain point, to be under the I would say, surveillance of the IMF that could then be entitled to look into the policy mix of the country, things like that. The more you see the functioning or the dysfunctioning of the system, as I tried to show it, the more you are inclined to look into these issues with a sense of innovation and responsibility. I don't think we can continue to cling to these methods of, doing what you want à la carte. I think the system is too interconnected today to allow these things. Now, it doesn't mean that some countries are going to have to revalue their currencies. It means that the policy mix that leads to continuous imbalances, be they on the plus side or the minus side, have to be reviewed. And there has to be an element of automaticity in this review if you want it to bite. So in all my life, I never managed to get that done. But I hope that situation being worse now, maybe something will come out of all these talks. Okay.
Another question over here.
Yes. Yanis Tsiligakis from the Henry George School. I have one comment. First of all, it seems to me that economists have no idea what money is. And that's a big problem with the current economic crisis. Money is just an indicator of wealth. Okay, so it seems to me that American economists have it all wrong because they expand the monetary supply when the economy has contracted. So it means the wealth of the country has contracted, yet they increase the money supply. On the other hand, Europe seems to have a more correct understanding of what money is, and instead of expanding the money supply, they put their economies into recession to counter this economic contraction. So I would like you to comment on that. And another question is, it seems to me that this current crisis has resulted because we shifted wealth from the productive factors of the economy, that's labor and capital, into land, which is unproductive. What would you think of this measure, which be untax wages and capital and tax heavily land values as a way out of the crisis? Thank you very much.
Yeah, well, I mean, there's a lot of controversial things in what you said. First of all, the comparison between Europe that chooses recession in order not to overexpand its money supply and in the US, excessive money supply. I think things are more nuanced than that. There has been a very active increase in the balance sheet of the ECB, not as large as what happened with the Fed, but there has been a great contribution of the ECB to the liquidity of the financial system in Europe. So it's more a question of degree, and it's the quantitative easing policy probably that you have in mind, and that is indeed to some extent different in its orientation. But things are not exactly as different as you may characterize them. Now, when you say that it would be better to tax very heavily the real estate, if I understood you well, or acquisition of houses, and reduce the taxation on labor and production, I think that you have to understand that the demand for housing is not only a speculation, it's also a sort of social legitimate request from people who want to have a roof over their heads. And to overtax the acquisition of property in the housing sector is not necessarily the best way to do it. There are other real, if I may say so, assets like gold or other financial instruments that that could also be in your tax targeting. So I think I wouldn't buy that as you presented it. I think it's a little more complex. What I think fundamentally is that the system must not put acquirers of houses at risk. That is my thesis. I think it is dangerous to overdo the lending side. In the US, you have a system whereby the house is in a way the guarantee of the loan. In Europe, it is a different system. The banks lend to mortgage candidates, not on the house, with recourse on all forms of revenues and assets that the individuals have. That is a very disciplinarian method, much more than just lending against a house, because the borrower has to make calculations not on the value of his house or her house, but on the future of its incomes, and banks have to make a very careful assessment of what the repayability, if I could put it that way, of the loan is. Whilst when you think that you've got a good collateral with a house, when you're a bank, well, you're exposed to the risk of falling prices, which we have now in your country. So I think the way you do it, and also the buying systematically of mortgages by GSEs like Fannie Mae or Freddie Mac, is something that we don't know. In Europe, there is no Father Christmas to buy banks' loans in terms of mortgages. They have to keep them on their books. So it makes them perhaps more prudent. And so I think it's those things more than banging people on the head with taxes that is important.
Maybe we can take another question from the other side.
Thank you. My name's Chris. I'm a graduate student here in economic policy. My question is one of economic governance in regard to an international reserve currency. You spoke briefly on global imbalances. In particular, we've seen that the US dollar as a standard reserve currency is dependent on the US continuing to run a deficit. Do you have any opinion or discussion on using special drawing rights as an international reserve currency? And if so, would that be under the domain of the IMF, perhaps?
Yes, I thank you for your question. I think indeed the system is now very dependent in terms of the providing liquidity to the system is very dependent on the deficits of the United States, in a way. Now, it's not absolutely indispensable to have a balance of payments deficit when you are a reserve currency. There have been examples in the 19th century and the beginning of the 20th century when the United Kingdom was, with the pound, the main reserve currency, didn't have balance of payments deficits. It had actually surpluses in its current account or its trade account, but it exported out long-term capital, which of course balanced the situation. And it would be an ideal situation, if I were American, I would say that, to have the US dollar as indeed the international monetary currency, which it is, but to have it without these very problematic continuous deficits. But okay, it's not doable now. Now the SDR question is I think it's a very good question, because if you do really overhaul the functioning of the system, I think you have to ask the question, wouldn't it be better to have an international currency issued by an international organization or central bank, which the IMF could be the prefiguration of, which would issue a international currency like the special drawing rights. Now, you have to understand that the special drawing rights is only a mirror of the major currencies in the world, that is the United States dollar, the euro, the pound, the Swiss franc. I mean, that's basically what the SDR is. So if you want to have a stabilization in the system, you have to have a discipline amongst the countries which feature the SDR, certain form of discipline, because if they have too large variations against each other, then in a way you replicate the erraticism of the present system. So you have to have an element of convergence, which brings you back to what I said in terms of the surveillance of the international monetary system, imbalances, and all that. Now, if you had that, yes, the SDR would be a way to provide liquidity if you had a need of liquidity in the system. Presently, I don't think you have a need of liquidity. You probably have too much liquidity. But it could be that one day you would have a need, and then the SDR would fulfill its function, the one that was bestowed on it at the very beginning, and which was never really carried out because when I was managing director of the IMF for 9 years, 9 times each year, religiously, I went to the board and I said, the economists of the research department have determined that there was some, what did we call it, scarcity, and there was a word, a sacred word, in liquidity. There was a need for more liquidity. And 9 times I was turned down by all the disciplinarians of the board, which said, no, there's abundant liquidity. It's badly distributed, but it's abundant. So no way that we will create SDRs. Now, the G20 has managed to make a creation of SDRs 2 years ago, which I think is an interesting step forward, but it's still very small in terms of the SDR and the total liquidity. It must be sort of 4 or 5%. So it's not making a dent. But, you know, we never know.
I think we can take one more question for this side.
Yes, sure.
Mark Malaika, Columbia University. Thank you very much for the comprehensive analysis. I have a very short question I always wanted to ask a central banker. Did you foresee the crisis? If so, when and why, and how did you act upon?
Well, this is a good question. I'm on the record on this. I will send you, if you will, the statements that I made in 2004, 2005. Yes, I did say publicly that the ebullience of the housing market in the US was a sign of what I call systemic crisis. I was immediately corrected negatively by some very high personalities of the monetary world, and I shut up. But things happen. So, you know, I'm not boasting about that. There's nothing. I think it's, in a way, the guy who saw me at the customs the day before yesterday was perfectly aware of these things, and was a collective misjudgment. Thank you very much. I much appreciated your questions, and I hope I didn't bore you too much. Thank you.
Thank you.